Since this is an election season, my title is Promises, Promises. This was a Broadway show, but there was a Broadway show. Neil Simon wrote it, Hal David, Burt Bacharach, music and lyrics. Only in their promises and promises, those promises were not of a political nature. Here's the two candidates. One side, I'm not with her, and the other one is, I'm not with him. And that seems to be the general attitude for about, not the whole population, but maybe half the population feels we need different choices, but we have what we have. Here are their programs on roughly. Donald Trump wants to cut taxes by $4.4 to $5 trillion over 10 years to corporations and mostly high-end individuals. He will have 100% expensing in some cases for a corporate capital investment, higher tariffs and a rewrite of trade deals, maybe a trade war, more money on defense, homeland security, and infrastructure. Wants to deport roughly 5 million people, and less regulation. So that's essentially, from an economic standpoint, that's essentially what Trump is talking about. Hillary Clinton, when I put this as $500 billion in tax increases over 10 years for high-end individual, it's a higher number right now. It's closer to a trillion, not 500 billion, because that number seems to go up every day. And the other thing is even though the Democrats concede, what she wants to do on the tax side is very complicated. So it will be called the Lawyers and Accountants Relief Act of 2017. Because it will work for lawyers and accountants. It may not work for other people, but it will work for them. She wants more dollars for health care, infrastructure, college aid, and Social Security, and has some kind of an immigration reform proposal if it could get through Congress. So that's essentially the differences. Now for modeling, but next thing is, no matter who wins, deficit's going to go up. If Clinton wins, it'll go up a little less. If Trump wins, it'll go up a lot more. Deficit's going up, and it will continue to go up because, as Ed discussed, is the entitlement programs begin to kick in. Even if we get more economic growth, it's not going to matter. The deficit just goes higher and higher and higher. And we may challenge, if we get a recession, we will go through that $1.5 trillion deficit in 2010 pretty easily. Now, the other thing going on is if you want to see how the election who's going to win the election, all you really have to do is look at the chart of the Mexican peso. And if you notice over here, when Donald Trump was beginning to move up in the polls, the Mexican peso moved from 18.5 to the dollar to close to 20 to the dollar. So the higher that goes, it means the lower the peso, because it's pesos per dollar. That's the chart. But if you take a look at the very, very end, right after the debate, the peso rallied by 2%. So the thing is we've got these bloodless currency traders. They don't really care who's going to win, who's going to lose. They just want to make money in the currency market. And while the debate was going on, you could watch the Mexican peso. You didn't have to watch the debate to know who was winning. All you had to do was watch the screen of the Mexican peso. And if the Mexican peso started to rally, you knew that Clinton was winning the debate. If the Mexican peso began to weaken, you knew that Trump was going to win the debate. So that's all you have to know as to predict who's going to win the election, because these are bloodless currency traders. It's a very, very deep market. And so that's what I recommend you do for the next couple of debates. It keeps it simple. Now, for modeling purposes, we're assuming Clinton's going to win, because it's very hard to model what Trump is proposing, because we really don't know what the trade implications are going to be and the immigration is going to be. And also, in the interest of full disclosure, I wrote an op-ed piece in the Los Angeles Times in August saying I was going to reluctantly vote for Hillary Clinton. So that's the interest of full disclosure. We're assuming here not a lot will get done, because at least one house of Congress, and this will remain Republican, and maybe two houses of Congress. So what we're modeling is we may get more infrastructure from what Hillary Clinton wants, but we're probably not going to get the tax increases, because that's the path of least resistance. They'll raise the deficit, because the tax increases won't fly with a Republican House. We think GDP is on a 2% growth path. business investment rebounds, and inflation will be above 2%, and the Fed begins to raise interest rates gradually. That's the rough forecast. The problem with promises is, and Ed talked about this last quarter, we've had horrible productivity growth. Productivity growth has been less than 1%. And real GDP is the change in the labor force plus productivity growth. So if labor force is growing less than 1% and productivity is less than 1%, it's very hard to get more than 2%. So that's the problem. So anybody who promises 3% has to promise higher productivity. And I got to let you in on a little secret. Donald Trump or Hillary Clinton, they do not have a magic wand to say productivity will go from 1% to 2%. So they can't deliver, at least in the short run. Bob Gordon wrote a book about this, The Rise and Fall of American Growth, talking about the recent growth in the United States was really a one-off from 1870 to 1970, and computer and communications technology really doesn't hold a candle to what happened in the 1870s, way, way, way back then. Because back in the 1870s, within a few years, we got electric lights, we got telephone, we got internal combustion engine, we got indoor plumbing, and we got public health improvements. It took a long time for this to work its way into the economy. So even if you're a bull on communications and computer technology, it's going to take a while. The country really wasn't electrified until the 1920s, from the 1870s. And my question to all of you is, if you want to look at technology, would you trade indoor plumbing for an iPad? Ed would. He said that yesterday. He would. But I think most people won't. I think indoor plumbing is a much better invention than the iPad, the iMac, iPhone, whatever. That's a big deal. So it's going to take a while for the productivity to really work its way through. So anybody's talking about a big acceleration of economic growth, take it with a big grain of salt. Now, if in the 2020s, you can make up whatever you want. But the next 2 or 3 years, very, very difficult. So here's our forecast, roughly 2% growth. We rebound from the weak first half because the inventory cycle seems to be over. We have 2.8, 2.9 for the current quarter. That's roughly consensus. And then back to 2%. That's the forecast, which is what we've had for the past 6 years. Unemployment stays down, roughly around 5%, a little bit below. We're at full employment. Job growth will slow because we're running out of people in a sense. So we're going to go from 200,000 to 180 to maybe 125 by 2018, 125,000 jobs a month. Consumption growth is going to cool. We had very strong in 2015, 3%, gradually coming down. Now why? The reason is auto sales have leveled off. Auto sales had a big recovery. We're up to 17.5 million. I'm going to sort of stay there. Not going to go much higher. And that's the weakness in the slowdown in consumption growth. But that will be offset. That will also be helped by housing. We thought 5 years ago we'd be at 1.4 million by 2014 or 2015. We were wrong on that. We now think maybe we could get there next year at 1.4 million. Back to where we were in 2007, but this was once 2 million. So we're nowhere near the old high. Now, why the economy was slow really in the first half, part of it is equipment spending negative this year. Business spending is weak. A lot of that is oil related. Non-residential structures, negative 2 years in a row. Now, if you drive around LA, especially downtown LA, you're looking up at all the cranes. So how could this be negative? Because we also have this in other big cities in the country. Commercial construction is booming in most parts of the country. The reason is that oil drilling and related construction is a bigger industry in the United States than all of commercial construction. So we have this big collapse in oil drilling, brought this down. That negative will end this year. And so when the negative goes away, we'll begin to see the positive effects of the regular commercial construction that we're used to. So that begins to turn around. And the other thing is exports. Very, very weak. So it's basically the consumer and housing. That's what's been carrying the economy. So what we're seeing is we think we're going to get a reasonable handoff where the consumer slows and the business side of the economy and the export side of the economy picks up a little bit, and that's how we maintain the 2%. If we don't get the handoff and business and export doesn't come back, then 2% could be a high number. So we need this handoff because we don't think consumption could maintain the 3% pace that we had last year. And the other thing going on is we're already in core inflation, we're already above 2%. And we're going to stay above 2%. Headline inflation, which went negative because, or almost negative because of the drop in oil prices, all you have to do is say oil prices level off and go up a little bit. Headline inflation will be above 2% too pretty quickly. So our sense is the Fed's going to take a look at it, and they're going to say, the Fed will basically see inflation moving up. The Fed will see wage increases on the order of 4%, and they're going to begin a gradual policy of raising rates. We think they'll move in December, then they'll move 3 or 4 times next year, and then the Fed funds rate by the end of 2018 is above 2%. Now this is a little bit above the latest, quote, dot plot that the Board of Governors, that the Fed released at the latest Open Market Committee. It's about maybe 1 or 2 tightenings higher than what they put out in their latest dot plot, was where they think interest rates are going to be. So still lower for longer, but the problem with low rates, and everybody says low rates are good, and the sense is it raises asset prices. So we have this nice rising stock market, we have rising house prices, low rates are great. Except what people tend to forget about low rates, it also increases liabilities. Because when you discount a future liability at a low rate, it's a bigger number, as in a pension plan or an insurance policy. So in the current rate environment, what it does is it destroys the funding models for pension plans, for life insurance companies, and for annuities. The numbers just don't work because no one ever contemplated 1.5% treasury rates for a long period of time. Short rates you could have low, but long rates at this level basically destroys the business model for pension plans and insurance companies. The problem is especially severe in Europe, where they have much bigger unfunded liabilities than we do, and the markets can't provide an adequate return to fund these pension accounts. So what it means is that if you take a look at most of these plans, if you really marked them to market right and did it right and assume long rates stay low longer, it means we have huge systemic risk that the pension that people were promised will not be there. And on the public sector side, what it means is either huge increases in employee contributions, huge cut in benefits, or alternatively a huge increase in taxes to make good on those obligations, or a combination of all three. So the longer this thing goes on, the systemic risk. Fed governor at the Boston Fed, Rosengren, and he used to be a super dove, basically when he outlined his case for raising rates, and he dissented at the last meeting, this was one of the issues. This is one of the issues he's raised. And I think the Fed is beginning to wake up to this fact. The European Central Bank is waking up to this. The Bank of Japan is waking up to this, is that something is not, they're going to have systemic risk, not next year or the year after, but come 2019, 2020, 2021, we're going to all find out is that a lot of these pension plans will not be able to make good on the promises that they've made. So to conclude is given our political assumptions, I think we're on the same tepid 2% track we've been on. Unemployment and inflation reached their Fed targets. Deficit's going to go up. We need a rebound in business investment to make things work. The handoff from a slightly weaker consumer, we need a stronger business investment. And we think that'll bring with it a modest normalization cycle in terms of the Federal Reserve, where interest rates, short rates will gradually rise and long rates will also gradually rise with them. Thank you very much.